Hey everybody and welcome back to another video. This is How to Invest. Spencer here. This one is going to be on when is the best time to buy a stock. When I say that, I'm talking about time of the year, what month or even season. So if we look at the indices today, they are, about break even. The S&Ps is down 0.08% after being down most of the day, making a comeback. The Dow 30 is down almost 1/3%, a little bit more, and then the Nasdaq's up 0.5. If we look at the S&P here, it's been kind of range bound for a little bit. See, back in the beginning of the month, we were at 4,200 or 4,200, and then we're back right where we were. We look at 6 months, we are right about where we were the beginning of April, and we can't really push forward. And a lot of people are asking what's happening in the market, why is this, and where's the movement? Well, like if something's going to happen, a lot of people are freaking out over inflation, a lot of people are wanting the stock market to go down more, and then a lot of people are bullish saying that the market's been reopening great and companies are having great earnings and revenue, much better than anybody expected over a year ago. And a lot of people are just asking where is the movement, and I think I may have some answers for you. So if you want to tune in, this is a chart of the S&P 500 seasonality. So this is over the past 20 years, the average return. And as you can see here, it is quite heavily weighted towards the beginning and the end of the year. And then this middle, about 1, 2, 3, 4, 5, 6 months from the end of April, beginning of May to October, there's not very much upward movement. There's a lot of volatility in there. There's a lot of tests to push forward, and then a lot of crashes or semi-corrections, but there is not any real gains for 6 months. And this is over the past 20 years averaged out. A lot of the majority of the gains happen in March, like we saw last year during the COVID crisis, COVID crash. There was a quite swift move downwards into March, and then March has a general uptick. This is a little bit influenced by the 2020 crash because it was such a downward move. Obviously, heavily weighted occurrences are going to be kind of shown out here. And this is another part of the year back in 2020, which was heavily weighted and definitely does affect the graph in a major way because it was so heavy. We can see down here the max returns. 2020 for April was 12%. 2020 was for November. So we can see here November had that crazy upward move, definitely influenced the graph. 2020 again. So 2020 had one of the best years, and then one of the worst years here, down negative 12.5% for a month, was the second worst here, as opposed to negative almost 17% in October for 2008. So that's why we see a little bit here affected by it. But there is a very, very common saying throughout the stock market, investors, and typically upon older investors, that is sell in May and then go away. Go on vacation, take a trip, and then just go away for the summer. And you won't really miss anything because of this lack of upward movement. But I'm going to get into my major problems with that argument or saying. And first, we will look here. I just wanted to give you an idea. The S&P 500 is heavily weighted by the top companies. Not as much as the Nasdaq or the Dow as much, but there still is quite a heavy weight in the top of it, which does move them quite a bit. But the S&P 500 is a huge indice, and that is just the averages. So there are also great deals going on within these summer months that we see these downward moves. Some of these stocks, if this is a negative almost 2% for the indice, that could be 10% for some more speculative or growth stocks, or even if the company just has some question marks around its business model, it could go down double digits during that time of a 2% downtick for the index. And they're just missing out great deals if you sell in May and then just go away and you're not looking at the stock market. If you're a long-term investor, I think that is a huge mistake, just considering the amount of companies within the stock market and just the amount of opportunity. So here is an article kind of validating what I've been saying and what I've been trying to show you guys. Summer doldrums in the stock market. If you guys read a lot of older investing tomes or spoken with stock traders of a bygone generation, you might have heard the phrase summer doldrums come up from time to time, or sell in May and go away, like I said. Though the concept of summer doldrums isn't nearly as popular these days as it once was, we now live in a always-on interconnected world. This is very true. People are always trying to make money, and there's constant hustle going on in the stock market. World where people are able to access markets from the furthest reaches of the world. You can be on vacation on a beach trading stocks if you really wanted to, and there's no problem with that. It says play important psychological role in the stock market depending on who you ask. First, let's get the definition. Summer doldrums refers to the perception that the period from July, from the stock market seasonality, it started in April, but July, there's a slight about 0.5% increase, which doesn't really matter. You might miss out on some gains, but it never hurts to sell out early and take some gains. But July and Labor Day is particularly dangerous for investors because there are many away on vacation. As a result, volatility is higher because liquidity is lower than it otherwise would have been. As a result, stock price fluctuations tend to create a lot of financial pain for those who would attempt to trade stocks. Are the doldrums real? Whether they're a real phenomenon or not is largely a case of cherry picking, and confirmation bias on parts of traders is up for debate. What we do know is the concern over liquidation is not pronounced as it once was, and it is now possible for investors to trade easily when they are on vacation. What is not up for debate is in my mind at least, is that it's all nonsense and a useless distraction to the goal of building wealth. That is because those who have been reading my work know that I am a long-term investor. Very similar to me, in the truest sense of the word. At heart, my capital allocation philosophy, which I not only use in my own life, but my asset management firm, resides in following lists of behaviors that make worrying about things like the summer doldrums meaningless. So don't buy common stock or preferred stock in your brokerage or custody that you don't feel comfortable for holding at least 5 years. This is kind of the Kathy Wood point of view, where she is looking for growth and she's not looking for short-term gains. She's looking for a 5-year outlook, and if this company can outperform the market over 5 years, she's much more happy than holding it for maybe 1 year or maybe even less than a year and having to pay higher capital gains tax for the short-term capital gains as opposed to long-term capital gains. Do not borrow money on margin. I'm a big believer in this. I do not borrow any money on margin just because I think it's a dangerous game getting into, especially when you're starting off. Maybe if you're a more experienced trader, it is important, but if you're a long-term investor, there's no reason to use margin. If you really want, you could buy options, which will be more lucrative if you are very keen or you are very certain on a certain stock. Diversify your portfolio and understand why that's important. This is more for when you have wealth. I think that when you are not as wealthy and you're still trying to build up wealth, I don't think it is as important to trying to diversify. And I'll say this because it is important to learn and understand why you're buying stocks and what the reasons are for, what the underlying bull theses are, the numbers, if you're running numbers on a company. And I think it is very, very useful and helpful to do these. And I think that if you find one very, very good stock, as opposed to if you researched maybe 50 and you find one that you are very bullish on, and you have 49 that you aren't as much bullish on, then I think if you have only $1,000, I don't think that it's a sin to put in all $1,000 in that company. But especially as you're building up your wealth and you have more and more digits in your bank account, I believe it is to try to hedge your bets and manage your risk. And then 5, pay attention to the asset placement strategy to maximize your after-tax results. For example, except in most unusual circumstances, you shouldn't own a tax-free municipal bond through a Roth IRA. I don't really get into this because I don't have an IRA or a Roth IRA currently. Maybe further down the line, like I said, when I do have more wealth. But rather than worrying about theoretical summer doldrums, it is more crucial that you continue to add money to your portfolio if at all possible. In addition, make sure your investment fees and expenses are reasonable. This might be an older article, yeah, about a year ago, because fees are basically a thing of the past now. But that was kind of just validating everything that I said, that these summer doldrums aren't really they are a real thing, and they do happen, but there is insane volatility within this 6 months, and they're great buying opportunities. So definitely do not sell in May and just go away. Definitely check the stock market every day. There are great opportunities each and every day, even each and every hour. I went to buy a stock this morning. I said, oh, I'll buy it in an hour when I have my next break. And it was down for the day when I first checked it, when it first opened, and it came back. It was up 7%. So never miss out on a buying opportunity. And if you made it this far, thank you for watching. Have a good one.